Question number 3 of Fundamental Management Accounting, August 2023. The question reads, question 4. Evaluate for advantages of centralized material purchase by an organizations. What is centralized material purchase? Centralized purchasing is whereby we have allocated one department that is doing all these particular purchasing in organizations. The purchasing situations where each and every department is buying the goods for their own, we shall refer to that as departmental or decentralized purchasing. Now in this case, we need to evaluate the advantages of centralized purchasing. Number one, advantage number one, we talk of cost saving through bulk purchasing. That is cost saving through bulk purchasing. That means that when you buy more goods, you are going to be given what we call quantity discounts. At the end of the day, you save on the cost. Number two, we talk of expertise specializations. That is expertise and specialization. We have the people in a particular department, they can only be focusing and specializing on matters to do with the purchasing, enhance negotiation power, enhances negotiation power. You get an advantage. Why? Because you are buying goods in bulk and you are buying at one. Now, therefore, you can negotiate for better terms. We can talk of streamlined process and efficiency. Streamlined process and efficiency. Streamlined process and efficiency. Then we can talk of standardizations and consistency. Standardizations and consistency in productions. Because in the event a particular department fails to acquire, we know that where we are going to deal or where we are going to do a follow-up in such a process, compared to when each and every department are doing the purchasing. Question number B. Shauri Moyo Bakery Limited manufactures planned production and sales for the next 7 months for the financial year 2023-2024 is as follows. We have the production for the year November is given. Let me just edit here. We have December, January 2024, February 2024, March 2024, April and May. The sales and production units have been given there. Additional informations. We are told that the selling price per unit is 30,000 throughout the period. Full stop. 40% of the sales are normally made on 1 month credit, and 60% are settled in cash within the month of sale. 40% are given allowance of 1 month credit, while 60% paid by cash in the month of acquisitions or sale. The purchase of raw material are 1,000 shillings per unit of productions will be paid after 1 month delay, meaning the material purchased in November are going to be paid in December, and December will be paid in January as we proceed. Direct wages is 6,000 per unit of productions. Time lag in payment of wages is 50% of the month sales. month of sales. Time lag in payment of wages is 50% in the month of sales and the balance in the month following of sales. Okay, then we are having during the period the business plans to advertise its product. Payment for advertisement is 10 million and 15 million will be made in January. Payment for advertisement of 10 million and 15 million will be made in January and March respectively, correct? Production overhead during the period to that 31st December 2023 had been at 18 million a month and are expected to rise by 2 million per month. Now January will be 2 million in increase, February also increased by 2 million, and proceeding that order. New packing oven machines will be bought and delivered in December 2023. The machine will cost 6 million. This will be paid 3 equal installments in January, February, and March. Okay, a loan of 100 million is being issued in December 2023, and the amount is expected to be received in early 2024. February, interest on loan of 1% per month shall be charged from February to February 2024. Outstanding tax liability of 16 million is due in March. The same month the company intends to dispose a surplus oven. The net book value for that, okay. Depreciation expense is expected to be 5% of actual sales per month. Then the bank balance as from January 1st is expected to be 15 million deficit. Required to prepare a cash budget for 4 months ending April, meaning we are meant to prepare a cash budget for January, February, March, and April. Now, because the question is long, I'm not going to be scrolling back and forth. I'm just going to use this particular hard copy to compute. Now, we need to start adjusting the sales proceeds. We were told that the selling price per unit is 30 throughout the period. 40% of sales are normally made on the 1 month credit and 60% are settled in cash within the month of sales. Therefore, we are going to have okay, let me prepare my worksheet. These are workings. We are going to have that is November, December, January, Feb, March, April, then we have May, then we have November, December, January, Feb, March, then we have the other one is what? Is April, then we have May. Now we are told that 30% of sales. Now the sales, we just take a unit produced in November, that was 800. We are multiplying by 30. Let me take 3 zeros up there. Then we are told that multiply by 30, carrying 3 zeros. We have 24 is 80 multiplied by 30 800 multiplied by 30, have 24. Then you are told that 60% is on credit, 60% is settled in cash within the month of sales. Now 60% of this multiplied by 0.6 is settled in the month of sales, meaning 60% of 14,400 was settled in November, and the balance of 40% was paid when? In December. That was 9,600. We do the same for December. That is 1,000. We are multiplying by 30, we get 30,000. 60% of 30,000, that's 0.6. Multiplied by the answer, we have, 0.6 multiplied by 30. Have 18,000 was paid cash in December. Then the balance of 30,000 minus this one, you have 12,000. 12,000 was paid in January, right? Let's go to January. How many units did we sell? We sold 1,200. We have 1,200. We multiply by 30. We have 36. 60% of these were paid. That is 0.6 multiplied by the answer. We have 21,600 was paid in January. 21,600. Then the balance, and 0.6 multiplied by and the balance of that 6 minus the that 600 minus 21,600. That's the balance was paid in February. That is 14,400. Let's look at the sales we made in February. In February, we had 13. We multiply by 30, 39. Now we take 60% of this. 60% multiplied by this one, we are getting in February. In February, we had 23,400. Then the balance, that's 900,000 minus the answer. We have the balance of 15,600 was paid in March. 15,600. Then March, how many did we sell? In March, we had 14,000 units multiplied by the selling price of 30.42 multiplied by 6. We have 25 was paid in March. 25,200. Then the balance was paid in April, which was 16,800. Then April, we are told that we sold 16,000 units. Multiplied by 30, we have 48. It takes 0.6 multiplied by the answer. It is 28,800. And then the balance of 42 minus answer of 13,200 will be paid in May. But we are not interested in May. Now we can do the total for January, February, March, and April. Those are the figures we are going to use. Now in this case, we are going to have 12,000 plus 21,600. We have 33,600. Then we have 14,400 plus 23,400. We have 37,800. And then we have 15,600 plus 25,200. We have 4,800. 4,800. Then for April, we have 16,800 plus 2,800. We have 45,600. Those are the figures we are going to use as receipt from what? Debtors. Then we are told another thing, that a purchase of raw material of our 10,000 per unit of production and will be paid after 1 month delay. Purchase will be paid after 1 month delay. Therefore, we can talk of purchases. Purchases in bracket payment to suppliers. We are going to pay after 1 month delay. Now we can look at those of December will be paid in January. Let me just pick from December. That's December, January, February, March, April, and then we have May. Now the purchases of December were how much? We hit December 12th. We multiply by 10,000. We are carrying 3 zeros. That is 12,000. 12,000 will be paid in January. This will be paid in January. And the purchases of broad units produced of January was this one, the same. Have 12,000 multiplied by 10. The same, this one is going to be 12,000. 10 will be paid in February. Then February we had 14 units multiplied by 10,000. We have 14,000 will be paid in March. And the March pro units produced was 1,500 units multiplied by 10. We have 15. This one will be paid in April. Just as enough, we are interested in January, February, March, and April. We also told another thing, that direct wages is 6,000 per unit of productions. Direct wages is 6,000 per unit of productions. This is a direct wage. Direct wage. We are told that is 60%. 60%, but time lag of payment wages 60% of the month of sale, and the balance, meaning we have that is January, Feb, March, and then we have April. Now we have a delay of 50% of the monthly of sales. Therefore, we talk over which is 6,000 multiplied by what? Have 6,000 units shillings multiplied by the units of productions for January. Sorry, for December. Let's go back to December. Get 1,200. Get 1,200. $72. Now 72. 50% was paid in December, and then 50% is going to be paid what? January, which is 50% of this 0.5 multiplied by the answer. We have 36. Now 36 is going to be paid in January, plus 50% of the production of January will be paid in January, and the balance will be paid in where? In February, which is the same, which is we have 12,000 units. 12 and multiplied by 6. Sorry, we do away with 1 0. In that case, we have this multiplied by 50. It is 36 again. That's 600. Then 50% of January is going to be paid in February, which is 600. we have to add the productions of February. February we had 1400, we have 1400 multiplied by 6. And then we take 8,400, 0.5 of the same. Now 42 will be paid in February. Then the balance will be paid in March. 42. Then let's see in March how many did we produce. In March we had 1500 multiplied by 6, 9,000. Now the 50% of that is 4,500 will be paid in March, and then the balance will be paid in April of 4,500 plus. April, how many did we do? We produced in April 15, which is just the same, 45. Now we can do the total so that when we start preparing the cash budget, it becomes easier. The figures we shall already having them somewhere. 200 after 600 plus 4,200, we have a 78. And then we have 4,200 plus 45, 87. Then here should be 9,000. Then anything else that we need to handle, production overhead during the period is that, I guess that one is well indicated, but we also need to adjust. We are told that the production overhead during the period from that to December 31st has been at 18 a month and are expected to rise by 2,000. Now in this case, we can talk of production from December. They are going to rise by 2,000. Now meaning January, February, March, and April, we are going to have new production figures. In January, remember December it was 18, but we are going to add 2,000. We have 20 in January. In February, per month, increasing by 2 million per month. Now in that case, we have 20 million plus 2. That is 22. Then in March, we have 22 plus 2,000. We have 24. Then in April, we have 24 plus 2,000. We have 26. Those are the figures we are going to use. I don't think if there is another adjustment that ought to be done. So we have depreciations. Depreciations expense is expected to be 5% of actual sales per month. Depreciations expense. Actual sales per month. Remember the sales. We are interested in what? January, Feb, March, and then we have April. Now we can pick the units that were sold in January. January had 12. Here we had 13. Then we had 14. Then we had April 16. The selling price was 30. That's 1,000. And this one we are multiplying by what? 0.5% of actual sales per month. 0.05. Multiply the answer, we multiply by 0.05. Here we multiply by 0.05. The same with this one, 0.05. Let's see. That's 1,200. 1,200 multiplied by 30. The answer multiplied by 0.05. Half. And then we had 13. multiplied by 30, multiplied by 0.05, 1,950, 950, then we had that is 1400 multiplied by 30, that's 0.05, at 21 is 2100. Then we had 1600 multiplied by 30, multiplied by 0.05, 24. Those are depreciation expense. Now from that point, I guess we can now come up with what? We can now come up with our cash budget. We can now come up with our cash budget. I'm going to have this. These are the particulars. Then we have January, February, March, April. They are in thousands. It's better to note them. Okay. Now what do we do? The first thing is we have to start with the balance at the bank in January. We had a deficit. Let me put it a balance brought forward. Balance. Brought down, we had a deficit of 15 million. Negative, a deficit. We have cash inflow. We have a receipt. Receipt from who? From debtors. Receipt from debtors, we computed what we are getting from the debtor. Where are they? We had January. January we had that is 33,600. Now in this case we are just going to note here 33,600. Then February we had 37,800. 37,800. Then we had 40,800. Then April we had 45,600. Correct? Any other things that it was inflow? We were told that a loan of this one is being issued in this one and is expected to be received. Now let's call receiving loan received. Loan received as per additional information. Additional information number 7. Loan received, loan of 100,000 is being issued in that 1st December and the amount is expected to be received in early February. Early February, we are going to receive 100,000. 100 million, sorry. And is okay. Interest loan at the rate of 1% per annum is charged from February. Now from February, we are going to calculate the interest on this amount. Anything else that we received? Outstanding debt? No. Okay, we had an outstanding of this one That's number 8. An outstanding debt to liability of 16 million is due in March 2024. In the same month, the company intends to dispose a surplus baking oven with a net of this one, net of 11 million for, and that case proceed from disposal of what? Oven, which we are going to receive the money in when? In March. 6 million in March. That's 6 million. We'll get in March. Therefore, I guess that is all about the inflows. Then we can have a total cash inflow, which would be my A, and find the summations there. Then we can have the cash outflow. Cash outflow, we are going to start with payment to creditors. Payment to creditor. Payment to creditors, we had that particular figure somewhere. We computed. Creditors, purchase. We are told that the payment to suppliers, we have 12,000 in January, 12,000 in February, 14 in that month. Now it's just easier for us to indicate. At this one, you have 12. Then here we hit 14. Then we hit 15. What else? We had the direct wages. So we had working on that. Direct wages. What were we told on wages? We are told that direct wages, we had 50% slack. We got 72, 78. That is January, we had 72, 78. Let's see what we got in April. We had 8,700 and 9,000. 8,700. Then we also had 9,000. The next, we had advertising. Advertising, we were told something. Advertising, we are told that we see additional information number 4. During the period, the business plans to advertise its product. Payment of advertising 10 million. Payment of advertising 10 million. And 15 million will be made in January. Now in this case, we are paying 10 million advertising. 10 million. Of 10 million. And 15 million will be made in March. 15 million be made in March respectively. What else? We had production overhead. Production overhead, where in case we had adjustment, yes. Production overhead for January was 20,000, 22, 24. It was increasing by 2,000, remember. Now in this case we had 20,000, 22, 24, and 26. Okay, we had that's depreciation. Depreciation, we had 18, 19, 15, that order. 1800, 1950, we had 21, And we also calculated 24. There's something that I'm forgetting. We are told that outstanding tax liability, outstanding, that is tax liability, outstanding of what? Of 24. Is it? Of 16 million is due in March. Tax liability is 2, that is 16. $16 million is due in March. Okay, what else are we leaving out? Then we were told something that we can easily forget. We are told that interest on loan at the rate of 1% per annum shall be charged from February. Now we have interest on loan. Now from February, we are going to judge interest. The loan we received, it was 100 million. Now we have 100, that is 1 divided by 100. 1 divided by 100, we have that multiplied by 100,000. Have 1,000, that is from February, we pay an interest of 1,000, 1,000, 1,000. Yes, that is all. Now we can find the total cash. Total cash outflow, which will be my B. Let's try to ascertain the figures. 1200 plus 72 plus 10,000 plus 20 plus 18. Here we get 51. Okay, we have 12. From February, let me just get the total first. Plus 22 plus 1950 plus 1000. We have 44. 750. Have 1400 plus 87 plus 15,000 plus 24 plus 21 plus 16,000 plus 1,000. Have 80. 800. Then there's something that I just noted that is not adding up. We are told that purchase of oven, a new baking oven machine prepared and delivered in these are the machines will cost 6,006. That's addition information number 6. 66 million. This will be paid in 3 months from January. It's better before I proceed. I guess I can add it. That is oven. Purchase of what? Oven. Now in that case, 6 divided by 3, we have 22. 22. Then we have 22. Now meaning this one we are going to amend. This one also shall change the same to this one. Now in that case we hit 12. 12 plus 72 plus 10 plus 20 plus 1800 plus 22. Yes, we have 73. That sounds better. And then we hit 12 plus 7800 plus 22 plus 1950 plus 1000 plus 22. We had 66,750. And then this one we had 49,000 plus 87 plus 15 plus 24 plus 21 plus 1600 plus 1000 plus 22. 102, 800, 102, 800. And then lastly, that is 15 plus 9,000 plus 26,000 plus 2,400 plus 1,000. Plus 1,000. That is 53,400. And here 53,400. What about the total cash? Cash inflow, we have that is negative 15,000. We are adding that 3,600. We have here 18,600. Now for us to get a closing inventory, we are going to take 1,800A. Can have here, that is A minus B, for us to get closing inventory balance carried down, which is 18 minus 73,000. You get negative 54,400. As negative is what is going to be our opening inventory here, 54,400. Now this one we have to add 37,800 plus 100,000. Have 83. Here we have 83,400. Now 83,400, we minus the outflow, minus 66,750. We have 16,650. In that case, we have a positive closing inventory for February. That one we take it here. It becomes the opening inventory for March, 16,650. 16,650, we are adding 4,800 plus 6,000. We have 63. Here is 63,450. Now 63,450 minus the cash outflow. 60 minus 102,800. We have negative 39,350. Now negative 39,350 is what we are taking here as the opening inventory for April. That's 39,350. Remember, it is negative in bracket plus 45,600. Yes. So let me verify where there is 45,600. Yes, 45,600. 45,600. We have 6,200. 6,200. 250, sorry. 250. Then we have the answer. We are minusing 53,400. You have negative closing balance. We have negative 47,150. 150 as deficit. Meaning now in this particular cash balance, we had a at the end of April, we had a negative balance of, or a deficit of 47,150 million. Remember, they were in thousands. That's what you are told to do to prepare the cash budget for the 4 months ending that date, April 2024. In short, that is how the cash budget should be done. Even if we had many additional information that are required to compute, but you do systematically, you get to that particular answer. The important thing is to master the format, the formula. You have to do all the necessary adjustments like what we have done for you to get the correct answer. Thank you.